Assalamu alaikum everyone. Welcome back to my channel Rapid Revision. Today's video is about ratio analysis, and this is one of the questions from the past papers from O-level accounting. The interesting thing about ratio analysis is that ratio analysis is part of O-level accounting, it is part of Excel accounting, it is part of course IGCSE, and it is part of A-level accounting, plus it is also part of business studies O and A levels. So this is a quite important topic, and one interesting thing to note here is that it is tested in almost every exam. So almost every exam we have a question on ratio analysis. Here the question is from May June 2022, paper 21, that is paper 2 variant 1. It is also question number 4. The question here is saying Equa is a trader who sells household furnishings. She has provided the following information. They've given you closing values. Number 1 is your closing inventory, that is 14,650. They've given you trade receivables, they've given you bank overdraft, and they've given you trade payables. So the first two are your current assets, inventory and trade receivables. Bank overdraft and trade payables are your current liabilities. Then they're saying here for the year to 30th April 2022, they have given you revenue, they have given you purchases, and they have given you expenses. And then they're saying all sales and purchases are on credit. Inventory at 1st May 2021 was valued at 12,800. This is my opening inventory. Then they are saying calculate the following. So complete the following tables. You need to calculate gross margin. The formula for gross margin is gross profit divided by revenue multiplied by 100. Interesting thing, lots of students ask me that if there's sales returns, then what do you do? So if there is sales returns in the question, you do revenue minus sales returns, and that is what you need to write in the denominator, that is net sales, because sales returns is not revenue. When the customers return goods back to us, it's not part of our revenue, so you need to subtract that from your sales or revenue. It's one and the same thing. So what you will do here is that first I need to calculate my gross profit. So I know my revenue, I know my opening inventory, I know my purchases, I know my closing inventory, so I can see the formula of cost of sales here. So what I'll do here is that I will calculate my cost of sales. So opening inventory is 12,800 plus purchases is 72,250 minus closing inventory here is 14,650. And when you calculate this, you will get your cost of sales here. Actually, the formula for cost of sales is opening inventory plus purchases plus carriage inwards minus purchases returns minus drawings of goods minus closing inventory is equal to cost of sales. But the simple formula is opening inventory plus purchases minus closing inventory. When you don't have a lot of values, you just have three things here. So 12,800 plus 72,250 minus 14,650 will give us 70400. This is my cost of sales. So this is my cost of sales here. Revenue minus cost of sales will give me gross profit. So revenue here is 112,300 minus cost of sales is 70400. You get here your cost of gross profit, that is 41,900. This is my gross profit. So here you'll record, like you will have to apply this to the formula. 41,900 divided by revenue, in this case is 112,300, multiplied by 100%, which will give me 37.31%. So that is for gross margin. Then we are supposed to calculate the profit margin. So profit margin is simply profit for the year divided by revenue. Revenue in this case is revenue, but if it's net sales, you take net sales multiplied by 100. Here your gross profit is 41,900. We don't have any other incomes here, we have expenses, so you need to subtract expenses, 19,820, and what you get here is 41,900 minus 19,820 will give us 22,080. This is my profit for the year. Profit for the year is 22,080 divided by revenue is 112,300 multiplied by 100 will be 22,080 divided by 112,300 multiplied by 100 will give us 19.67%. This is my profit margin. Then, oh no, sorry, 19.66%. Because you need to round it off right like that. You need to round it off to two decimal places. You should actually follow this also, because if they have written it in the question. Then rate of inventory turnover. So cost of sales I calculated for the first part, that was 70400. So I will record that in the numerator, 70400, and average inventory is opening inventory plus closing inventory divided by 2. So opening inventory is 12,800 plus closing inventory is 14,650 divided by 2 is 13,725. So I'll write here 13,725. Then I'll do 70,400 minus 13,725, which will give me 5.13, and I need to write here times, because rate of inventory turnover is always calculated in times. Then there's a current ratio. Current ratio is current assets divided by current liabilities. Current assets in this case are 2. We need to take all the closing values for the current ratio. So current ratio, we'll take inventory closing value, we'll take trade receivable closing value, we'll write here 14,650 plus 12,700 will come in your numerator, and then you divide this by, you have two liabilities here, 5375 plus 7125. So you'll write here 5375 plus 7125, which is my current liabilities in this case. So 14,650 plus 12,700 will be 27,350, and you divide this by 5375 plus 7125 will be 12,500. So 27,350 divided by 12,500 will give us 2.19:1. You need to write this properly, 2.19:1, because it is important to also write is to 1, because this ratio basically tells you how many current assets do I have in my business to pay off my current $1 of current liabilities. So we have 2.19 of current assets to pay off $1 of current liabilities. In the next part, it is liquid asset test ratio. That is simply the formula is current assets minus inventory divided by current liabilities. This formula basically tells you that how many liquid assets do I have to pay off my current liabilities. In this case, we just have one liquid asset, that is our trade receivable. So if you can do this, you can do total current assets is 27,350 minus inventory, in this case was 14,650. So you're left with just one, that is trade receivable. So your numerator will be 12,700 divided by 12,500, that is your current liabilities. So your numerator will be 12,700 and our denominator will be 12,500 when we divide both of these. So 12,700 divided by 12,500 will give me 1.02 is to 1. 1.02 is to 1. That is it for, and this is for 11 marks. These are so easy, like very easy to score 11 marks in the exam, because it's just applying of the formula. You need to remember the formula and then you need to know how to apply it. Of course, you guys know this, that in accounting you need practice. So if you have practice quite a few questions, then if you get a question like this or any question on ratio analysis, you'll be able to solve the ratios, and that is very scoring in any exam. In the next part, I have written this for you guys, and also to save time for this video. Here they are saying one of Equa's suppliers has offered her to sell her a large quantity of inventory at a reduced price. Equa is considering accepting this offer and increasing her expenditure on advertising in order to sell more inventory. So simply Equa will buy this inventory at a reduced price, and then she'll spend money on advertising and try to sell this in the market, this extra inventory. So what they want you to do is that they want you to analyze the situation and give two advantages and two disadvantages of this particular situation. So here I have written this for you guys. If Aqua purchases additional inventory at a reduced price, this will reduce her cost of sales. Of course, cost will go down because it is at a reduced price. Hence, her gross profit will increase. Also, her gross margin will improve because obviously gross profit is increasing. She can also pass down the reduced cost to the customers in the form of lower prices. That is also an advantage to Aqua, which will attract more customers. Hence, her revenue will increase. So she'll be able to sell more quantity of inventory if it is cheaper. However, she'll have to incur extra storage costs. So once she buys the extra inventory at a reduced price, she'll have to store that inventory somewhere, and she'll have to pay for the storage cost. And in order to store the extra inventory, also if inventory doesn't sell, it will deteriorate over time. That is also true. Also, increased advertising costs and storage costs will reduce her profits because advertising costs will come in the expenses section. Storage costs will also be part of the expenses section of the income statement. If she's not able to sell this extra inventory, these costs will just reduce her profit. She should purchase more inventory in order to expand her business. That is my recommendation. You can give any recommendation you like because recommendation is the student opinion on the situation. In the next part, they're saying explain the meaning and importance of the principle of consistency in the preparation of financial statements. Consistency principle says that accounting methods and policies should be consistently used from one year to the next. So if we are using a straight line method for depreciation, we should keep using straight line method for method of depreciation for the rest of years as well. So every year we must use straight line method of depreciation only on a particular asset. So if let's say it's fixtures and fittings and we are using straight line, so we keep using straight line method, so that my profits that I calculate are comparable from one year to the next. If I keep changing my methods and policies, that will go against the consistency principle of accounting. Also, the profits are not distorted, and your financial statements are comparable from one year to the next. In the next part, they are saying state two non-financial factors which may affect Aqua's trading results. So there are lots of things that the state of the economy, for example, is a non-financial factor. We can't give any value to it. Similarly, the skills of the workforce. So if the workforce is very skillful, but it is still subjective. You can't give a specific value, a numerical value to the skills of workforce. Also, the morale of your workforce, the workforce motivation. Also, it does not. You cannot give a specific value to your workforce motivation. So that is a non-financial factor. Also, business reputation and goodwill. So there's this thing called branding in business and in marketing. Branding actually gives your business another value. So there's a value of the brand as well. Also, there's this after sales service sometimes which is very valuable to the customers. So that is why customers are also loyal towards your brand or your business. So that all of that basically creates reputation in the market for a particular business. However, you can't give any value, numerical value, to the reputation of the business. So you can't give any numerical value. So you don't give a numerical value, then it's a non-financial factor. So thank you so much for watching. Hope this helps you guys.